start, but with a positive bias. So we're slowly inching up higher. Made it to that 90,450 thereabouts mark, but cooled off ever since. I can see Hero MotoCorp, BPCL, Bajaj Finserv, Bajaj Finance, Adani Enterprises. They're all holding up in the green as we speak right now. Uptick coming in on Adani Ports and UPL as well. Tata Motors, Hero MotoCorp, they're all holding out very smartly. Let's check in on what Hindalco is up to. That stock will just come up for you on your screens. Let's see the rub-off from Novelis's numbers. Hindalco just about very mildly up actually. Hero MotoCorp too, after that agreement with partners in Europe to start EV operations by 2024 on the sidelines of the Milan Auto Show. Hero MotoCorp holding up 1% as we speak right now. Power Grid, IRCTC, Apollo Tyres, Deepak Nitrite, they're all earnings reactions. Flat for Power Grid as we speak right now. IRCTC mildly higher. Apollo Tyres, of course, is a big dhamaka one. So over a 3% move. Deepak Nitrite, 4.5% jump up coming in on that stock. The EBITDA, remember, has jumped up about 12%. Margins have come in at 17%, which is quite an expansion from the same quarter last year, wherein they stood sub the 14% mark. But Rampur Chini, the gross margins are also up over 1,000 basis points, and we're going to be chatting as well with the management in the due course of the show. 1% higher for Balrampur Chini as we speak. Cummins, Voltas, these are all stocks which are in focus as well this morning. Anisha, what are you spotting?
Well, a lot of result reactions itself, as you pointed out. So Prince Pipes, of course, is higher by 7%. Prestige, Apollo Tyres, Minda, Cummins India, these are the names that we are watching out for. Our Policy Bazaar is actually a bit lower, so let's track that one. AIA Engineering and then Max Healthcare is the other one. Sectorally speaking, it's PSU banking names that continue to charge up. So Bank of India, Bank of Baroda, Punjab Sind Bank, these are your top gainers. And Realty, after that, a bit of a profit booking yesterday, is bouncing back, led by that solid gain on Prestige. The only name on the back foot or only sector per se is the banking index. So on account of the weakness in HDFC Bank and ICICI Bank, the banking index is a bit under the weather. So we are tracking that one, though the advanced decline ratio for the broader market continues to be very, very impressive. Kunal, any first trades?
Yeah, I think ICICI Bank looks attractive from the pack. The stock is heading towards a breakout of the 50 DMA at 950, 952 mark. So I think above those levels would be keen into buying the stock.
Okay, let's welcome on board then Prateek Gupta, CEO and co-head at Kotak Institutional Equities, to talk a little bit more about the bull run, sustaining, as well as which themes one should keep on their radar. Good to have you on board. Thanks so much for taking time out and joining in. Let's just talk a little bit more about how you've divided the large caps versus the mid caps. Do you believe that the risk reward looks better when it comes to large caps, even though some of them have been slightly underperforming as compared to the broader markets?
Hi, good morning. Yes, agree with you. The large cap valuations have become far more attractive compared to the mid caps. Just to put some numbers in perspective, the Nifty year to date from January till now is up about 7%, whereas the small and mid cap indices are up anywhere between 28 to 30%. And obviously, individual stocks have done far better. So while there's a lot of excitement around small mid caps given their recent performance over the last 6 to 9 months or so, but one also has to keep in mind the valuations and what the stocks are already pricing in. So while we're quite positive on the long term and medium term outlook for the Indian economy, for the businesses in general, but one also has to anchor their investment portfolio to valuations and what's already priced in, and the risk of disappointments. And you still have a lot of geopolitical events, risks out there. You have potentially, right now the markets are celebrating what's going on with the US Fed, that the rates have peaked. One never knows. Inflation is still running quite high, and they may actually be forced to hike again. And in India, we have the election risk. One never knows which way that might go. So there are still risks out there, but the more important factor is valuations. We are seeing at Kotak, we cover about 250 odd stocks, and we're seeing a lot of the small and mid caps are trading well above their pre-COVID valuations as well, which is not necessarily the case in all large caps. But in general, large caps appear far more attractive to us versus small and mid caps.
What within large cap then, Prateek? Hi, this is Anisha joining in the conversation. Is it just the financials and the private banking names that have been underperforming and and look a bit attractive?
Well, private banks is still definitely one of the areas that we still like. Again, as you rightly pointed out, partly because of their recent this year's underperformance and the valuations are still quite attractive. We still believe we're in the midst of a very strong banking sector upcycle for the next 2-3 years, wherein loan growth will remain quite robust in double digits. You will see NIMs coming off very, very slightly, and the credit costs will still remain quite low. And you have upside from faster than expected loan growth as and when the capex cycle, private capex cycle picks up. So in that context, the private banks, especially those with a strong liability franchise, the deposit franchise, they look quite attractive to us, especially again, given their valuations and how these stocks have underperformed the market over the last 6 to 9 months. So that's private banks, but we also like a couple of the leading PSU banks, similar logic, attractive valuation, strong banking upcycle, low risk of credit costs going up very sharply. But other than the banks, we also like, for example, the insurance companies, especially the life insurance companies, the real estate sector. Let me just talk about the real estate sector briefly. This is one sector where companies have generally deleveraged quite aggressively over the last 2-3 years. Their net debt to equity has come off very sharply. The pre-sales, which we have been seeing, especially in the last few months, have been picking up. The cash flows are looking strong, and interest rates have also, in our view, at least domestic interest rates are close to their peak. If not, they may have peaked already. So the outlook for the real estate companies, the residential real estate companies, is quite strong. So that's the other sector that we like. And last but not the least is consumer staples. India had a sort of a K-shaped recovery, post-COVID, and now finally we're seeing, the bottom end of the K gradually picking up, and we think there's upside over there. But yes, private banks, insurance, real estate, consumer staples, these would be the sectors we would be focused on.
I think it's just interesting that you say consumer staples, because what we've seen is down trading pretty much across the segment in lieu of an upscale in inflation. What makes you bullish in consumer staples?
So that is correct, but that in our view is more sort of backward looking. We think the worst of the downturn for the consumer staple companies is behind us. We believe first, you'll have the usual pre-election boost, typically government spending or political party spending. That's one. Second, the consumer is gradually recovering. We are seeing signs of the post-monsoon pickup in rural recovery. Third, raw material prices have come off. And fourth, our preference for consumer staples is that against of consumer discretionary, where we think demand there is still quite weak. And from a valuation perspective, we find consumer staple stocks still relatively better compared to, say, the discretionary names.
Given that, Prateek, the expectation is that we are seeing a strong capex boom, how do you believe investors should really play on that theme for the long haul?
So, yes, we are also in the same camp that you will see a long capex cycle, but capex has to be divided, in our view, in 2-3 different buckets. First is the government capex, which is central government capex. Then there is state government capex. Then there is PSU capex, and then there is private capex. And then there's also actually, I would call MNC capex, which is a smaller part of the overall capex plays. Now, as far as central government capex is concerned, I think despite all the excitement, one needs to keep in mind that, again, that is more of backward looking. It's, in our view, given the fiscal constraints, it is going to be difficult for the central government, whichever political party comes in next year after the elections, to sustain the growth in central government spending the way what we saw was happening in the last few years. Just to give you some numbers, the central fiscal deficit, which is budgeted at 5.9% this fiscal year, FY24, has to be brought down to 4.5% by FY26. So that's 130 odd basis points, which of a reduction in central fiscal deficit. So in that sort of a constraining environment, we don't see the scope for a dramatic increase in central government spending. Almost similar situation with most states. Most states are running large fiscal deficits. Again, over there, there's after the elections, there's going to be pressure on them as well to try and reduce their spending. So as far as government capex is concerned, we think the growth rate is likely to slow down. And again, a lot of the stocks are already pricing in that this sort of government capex will sort of carry on forever, which we think is unrealistic. As far as private capex is concerned, obviously we've seen some pickup and we are seeing green shoots all around and the order books are picking up, but the pace of the pickup is a bit slower than expected. So that's where, companies which are uniquely positioned or have strong balance sheets, have strong cost controls, they'll be better positioned. But again, we would not be carried away and recommend that you need to look at valuations also. You can't completely ignore valuations and just say it's going to be fantastic next 3 years, no matter what happens. But even over there, you do have all kinds of external and domestic risks to keep in mind. Companies are being somewhat cautious. So it is going to continue picking up, but perhaps not at the pace at which the stocks are implying right now.
Say the best is, could be behind, at least for the near term, in spaces like, say, defense and railways, which did get pretty frothy about 2 months back.
Yeah, I would agree. I think you got to be a bit careful in those spaces. The stocks have had a very nice run up. They're extrapolating whatever's happened last few months, last 1 or 2 quarters, and that I think is a bit dangerous.
But this entire, premiumization theme, Prateek, how are you playing that? And even the new age tech companies are showing signs of reversal, whether it's a Zomato, decent numbers from Nykaa as well. Would you now look at these companies also positively?
Yes, we've been positive on some of these stocks. And frankly, the concern with, depending on which company, but one of the concerns in the past was capital allocation and the cash burn that was out there. And after the sharp correction in stock prices, I think late last year, early this year, etc., in many of these stocks, partly triggered by a wave of pre-IPO lockups expiring and share sales, you saw the stock prices coming off very sharply. But either way, whatever be the trigger, but basically we have seen these managements become far more disciplined, one, when it comes to costs, their operating costs, and second, when it comes to capital allocation, meaning getting into new adjacent businesses which may burn up capital. And in fact, the efficiency which they're squeezing out has actually been quite impressive. So we think this trend will continue. And also because of the sort of lack of excitement in the private funding market, their competition, it's not easy for them to get funding easily. So that implies an implicit advantage for the existing listed players who already raised capital, are sitting on large chunks of cash. They have the ability to sort of keep on spending. And at the same time, what the market is liking is the fact that these companies are turning profitable or staying profitable in some cases. And the profit margins, EBITDA margins, contribution margins are improving. So that's actually a positive. We think structurally over the next 3 to 5 years, this is a good theme. In a couple of cases, unfortunately, the stocks have gone up very sharply, so there could be a near-term pause. But by and large, we're quite constructive on most of the new age companies, the listed ones.
Sure. Prateek, as a view here, what's this lively primary market telling you? I mean, literally there's an IPO opening just about on a daily basis and finding good subscription.
Yeah, so these IPOs, I think I would like to point out, Kotak is again involved in most of the IPOs in India, the leading IPOs in India. And what we find is the anchors typically tend to be the local investors, the domestic mutual funds, the domestic insurance companies. And these folks are still seeing very strong flows into either their small mid-cap funds or in general inflows into their equity funds. And the foreign investors tend to be, over the last few months at least, they tend to be followers rather than leaders in these IPOs as far as the institutional part is concerned. And then the retail and the HNI segment jumps in as well. What we are finding, though, I must say, in the last, month or so, there is some, the investors have become a little bit more discerning. The valuation expectations of the promoters are being brought down a notch because investors are indeed getting a bit cautious in terms of what valuations they're willing to pay. These are unlisted companies. There's a risk. They don't have a track record. So investors have to go with sort of management commentary and guidance on what the business outlook is. And to that extent, we are seeing a little bit of a sort of some of the froth being taken out. But I would just like to point out once again that this is really being led by strong domestic flows, and that should continue. Although typically what we've seen in the past, ahead of national elections, there tends to be a bit of a slowdown in the IPO cycle. So one should expect a little bit of a slowdown next 6 months.
On that note, we let you go. Thank you so much for making time and speaking with ET Now. But time now to take a quick look at the markets as well. Are we holding on to that level that we had opened with? Yes, so 19,400 is being maintained. In fact, we are building on to some of those gains as well. It's Bank Nifty as well that's holding on to decent amount of gains. So just watching out for that. And in terms of stock-specific action, it is HPCL, which is up another 7%. Yesterday, that stock was high by 6-7% after the commentary came in from the con call. And today, again, that stock is seeing quite a bit of spike. Apollo Tyres, Prestige Estate, Signature Global, Schneider being some of the other top gainers. But let's welcome on board the management of Minda to get a sense as to what their earnings are like and what's the road forward. We have Sunil Bohra from the management joining us on the show. Sunil, hi, good to have you. Thank you so much for making time and speaking with us. Well, the margins this time were a steady show, but the question is that given there are a lot of capex lined up, do you think going forward there could be a bit of a drop in margins?
So, good morning. As you rightly mentioned, we have actually delivered industry-leading growth, continued to deliver industry-leading growth quarter after quarter. Even in this quarter, we have grown by 26%. And as you rightly mentioned, to support this kind of growth, we have to continuously reinvest in the business. And recently, the board has also approved setting up of a new alloy wheel plant for meeting the new business requirements, etc. So, definitely in the short term, while we do expect the margins to maintain at around 11% plus minus few basis points, and when we say the guidance of 11%, the incremental cost, which normally tends to creep in once you commission the new plants, is already baked in. So we do not expect any significant deterioration or dilution in the existing margins per se.
So Sunil, this new capacity addition that you talked about just now, the four-wheeler alloy wheel, since this is going to substantially increase your capacity, how much of an addition to your top line are you expecting from this, and in how many years you think you will become EBITDA break-even?
No, so EBITDA break-even is not a big challenge, honestly, because this capacity what we are setting up, first question was on the revenue. So of the total investment of this 540 odd crores which you announced, it can deliver revenues of something like 700 to 750 crores of the total top line addition. Now, this obviously is into 3 phases. As we move up, we do not lump the capex upfront, and capex will keep on sort of adding plant and machinery as the demand grows. In terms of EBITDA, neutral. In fact, honestly, we are expecting it to be EBITDA positive in the first year itself. It's because of the high cost, you tend to have high depreciation and interest cost. So that takes some time to be PBT neutral, but EBITDA neutral, EBITDA positive, we expect honestly in the first year itself.
Right. And now in switches segment, you got the first order for captive touch bases switch from an Indian OEM. Does this now open the door for further growth here? What kind of potential are you foreseeing? If you could give us some sort of a number to it.
No, absolutely. So what has been happening, all these technological advancements have been happening at a very, very fast pace. You see the kind of electronics being added to every aspect of the vehicle, right? So even the switches now gradually getting from the lever-based switches to the touch-based switches. And that's how the journey is expected to be, right? If you see some of the top-end vehicles, while still there are both kind of options available, like you have touch-based switch also, you have lever-based switch also, but we do expect that gradually the market to migrate towards the touch-based capacitive switches. And the kit value definitely is higher than the lever-based switches, but it's all depends on the market dynamics and consumer preferences as to how this market will grow, because there are scenarios, there are people who would would tend to normally like the lever-based switches, because the change is always the difficult, right? So we do expect this to take some time before it has a mass penetration. It may be a few years before we see everywhere the touch-based switches get into the vehicles. Plus, it also has a cost component. So it also adds to the cost, because the more the electronics, the higher is the cost. So absorbing that cost into vehicle also depends on the OE strategy, which obviously difficult for us to comment on. But from our perspective, we always invest in technology, and that is how we have been able to provide the latest switches, which are, I would say, a step ahead from what the current switches are. And as I said, the absorption of that depends on the OE to OE and their strategy. How do they design the vehicle?
Okay, and you've also got commissioned of 2 new EV plants. You have a strong potential kit value to drive growth. So what is the expectation from EV contribution? How much can it scale up?
So from EV business, as you would have also noticed that in the quarter also, we have added almost close to 500 crore kind of an annual peak revenue. So our total order book from the EV segment per se, which includes the EV components and also the existing components which goes into the EV vehicle, the order book stands at roughly like, I would say 3,000 odd crores, which we expect to peak in somewhere in around FY26, FY27, because it has a ramp up, and we all know that the market has been today trying to absorb the impact of the FAME 2 subsidy reduction, etc. The volumes for two-wheeler has been lower in Q2 versus Q1, but we do expect that margins to sort of stabilize and also the ramp up to happen. So based on what we have been guided by our customers, we expect this peak revenues of 3,000 odd crores from both EV and non-EV components in somewhere in FY26, FY27.
Okay, on that note, we let you go. Appreciate you making time and speaking with us. So that's the latest commentary coming in from the management of Uno Minda. But time now to slip into a very short break. Don't go anywhere.
Tune into First Trades. I just want to identify what some of the result candidates are up to in trade. For instance, you've got an IRCTC where you had the EBITDA expanding about 20%. Margins, though, contracted. Revenues grew this time around to come in at 995 crore rupees. There was also Shree Cements, which came out with their numbers pretty spectacular. The profits were up about 2.5 times. You had the EBITDA as well, which scaled up. But Shree Cement, really, the stock isn't taking cognizance of those numbers. Something like you've also got something like a Power Grid as well, which came out with their earnings with a margin expansion and revenues, which were just about flat this quarter. 208, that's exactly where the stock is at. Cummins India as well, a pretty okay set of earnings where margins contracted to about 7.6% and revenues came in at 1921 crores. But GHCL is in the spotlight on the back of numbers, and we've got Mr. R.S. Jalan, who is now joining in on the show to chat a little bit more about it, because we've got the profits declining and you've also had margins coming in a little bit lower. Question is, can things rebound? Mr. Jalan, good to have you on board. Let's discuss that. What was the outlook in terms of your realizations and EBITDA per ton in Q2, and how much capacity has come from China? When will the next set of capacity be online?
Yeah, thank you. As you have seen, the number of this quarter has not been as expected from us. However, if you look at the next 2 quarters, definitely the margin will be under pressure. But if you look at the medium terms, definitely the industry is in a rebound position, and hopefully in 24-25, the number will be much better. In terms of the China volume, yes, there are 3 million tons of the capacity has come into China, but that has been absorbed into the China. However, US and Turkey, there because the demand construction in the Europe and US, there is a surplus situation that is coming into India. But because of that, there is an import in India has gone up, and prices are under pressure.
That the medium-term prospects are good, but talk to me about the realization, the EBITDA per ton. In terms of the actual numbers, what does it stand right now? And let's say 2 quarters from here on, after that, volatility goes away, what could be a stable number?
Yeah, if you look at a slightly longer terms in our business, you will see that barring the last 22-23, which was a peak period for the soda ash industry, the margin is in the range of around 9,000 rupees per ton of soda ash. And I think going forward in the next 2 quarters, margin will be in the range of around 7,000 rupees.
So 7,000, and that is purely because the soda ash prices have been volatile, or there are demand side issues as well.
No, prices are softened because of the import coming into India. The volume of import has increased by approximately around 150,000 tons, and prices under pressure. Of course, the cost has also gone down, but the margin is also kind of a reduced.
Okay, so that's the take coming in as far as the margin picture is concerned. But could you talk to me about what percentage of your product right now is used in solar glass making? And do you see this increasing going forward? Because that's the commentary we have been hearing from a lot of other players as well.
Yes, you are right. Currently, the percentage of soda ash used into the solar in India is very minimal. And as per our expectation, in next 5 to 6 years, this will go up to around 6 to 7%. And that's a big number. Similarly, if you look at the EV batteries, globally, right now, the EV battery, the percentage of soda ash usage is only 1%, which will also go to around 6%. That also is a huge number. If I give you a slightly bigger picture of the complete global scenario, the solar glass usage at this point of a time in soda ash is around 5%. And that will go to around 16 to 18%. And that's a huge number increase will be there. And all the new demand which is coming into soda ash, 50% will be coming only from solar and lithium carbonate. That's a big consumption which is getting into soda ash.
The other thing I also wanted to talk about, Mr. Jalan, and because you only flagged it off, what is the current demand scenario, both for the US as well as the Europe geographies? And do you see any meaningful comeback in demand from Europe in specific, now with, all the geopolitical risks as well at play?
No, you are right. At least in the next 2 quarters, we are not seeing any kind of a big demand coming in from US and Europe. Because, as you rightly said, the geopolitical systems are not very conducive to the business. However, like I said, we believe that next year, because of this demand growth into the solar and the lithium carbonate, probably you will see a big jump into the demand of soda ash.
Break it down, sir. Given the kind of weakness that we are seeing this year, what's a realistic volume figure that we should expect? And FY25, you're talking about a big scale up. What would be the volume, let's say, in FY25 then? What kind of growth can we envisage?
See, if you look at in India, still the demand of the soda ash in India is stable, or I would say it's growing. Approximately our estimation in this year, the demand for soda ash will grow around 3 to 4% in India. However, because of the import coming in, the prices are under pressure. So far as the volume is concerned in India, we don't see any kind of a worry on that. But if you look at 24-25, probably our belief is because a lot of new investment into the solar glass will be coming online. So demand growth in the 24-25 should be in the range of around 5 to 7%.
All right. And going forward as well, can you just give us a sense as to what the outlook is on the greenfield capex? You had an addition plan of 5 lakh MTPA. What's the status? And how do you see the economics on this kind of a project? What is the target in terms of your ROCE?
See, so far as this greenfield project is concerned, that is going as per the schedule. And right now, at this point of a time, it's under approval from the Minister of Environment. And things are going as per the schedule. All other basic engineering and other things are getting completed. In terms of, if you look at slightly longer terms of the soda ash margin, we have seen last 20 years of the data. On that basis, we believe that the margin will be in the range of around 30%. 30% EBITDA margin will be there. And based on that, the IRR will be around 18% on the new investments.
Sure. Mr. Jalan, great to have you on the show today. Thank you so much for taking the time out.
Thank you.
Okay, let's take a very quick break on that note. We started off mildly in the green and pretty quiet is where we're still at, though holding around that 19,500 print for the Nifty futures. When we come back, we're going to speak with the Balrampur Chini management and talk about their strong performance. management and the company currently in focus. Let's just pull up how their earnings as well have fared, because they've seen the gross margins see a phenomenal uptick, almost over 1,000 basis points, and the revenue as well has seen a perk up of about 38% on a year-on-year basis. So let me welcome on board the CFO, Pramod Patwari, joins in on the show right now. Pramod, hi, good morning. Great to have you on ET now, and one must congratulate you that in a seasonally weak quarter, you've managed to post a blowout quarter, both in terms of volumes as well as realizations as well. But are these levels sustainable?
So, good morning, viewers. So, you are aware of the fact that last 2 years were extremely bad for the Balrampur in terms of feedstock availability. So, we worked very hard on that, and as a result of which we are seeing we recovered 16% of cane which we lost in last 2 years. Going forward, also we have given a guidance that we expect to increase minimum of 10% cane from this level also. As a result of which, both the volumes were also better, and because of the economics of scale, the costs were under control, which also helped in better earnings.
Almost all of UP-based sugar companies have highlighted that a dispute between UP-based mills and state government pertains to determination of the levy obligation on molasses for earlier years. You've neither provided for it, nor have you spoken about it in your presentation post the numbers. Are you contesting against the government then? And or will you be providing for it in the coming quarters?
So what we do, we don't provide molasses to the country leaker. In lieu of that, we produce ENA and supply. As and when we produce ENA, that valuation of ENA automatically takes care of the lower profitability in our profit and loss account. So for us, it is a continuous process, quarter on quarter, and we don't to provide anything extra at this point in time. Going forward also, if we have to produce more ENA to satisfy the ENA obligation or the country liquor molasses obligation, it will automatically get reflected in third quarter or the fourth quarter.
Now, do you expect favorable intervention from the government in the form of, say, a higher, in the form of an increase in MSP or higher ethanol prices anytime soon?
So MSP was last revised in 2019 at 31 rupees. Currently, we are selling sugar at around 40 rupees per kg ex-factory. So as a rule, it has lost its relevance. But having said that, industry has been demanding to put the MSP in the right perspective at a level of around 37 rupees per kg. With regard to ethanol, we have seen an increase of around 2 to 3% in the FRP by the central government. So correspondingly, that increase should happen anytime now.
Point taken. I also wanted to get a sense from you regarding the next crushing season, because reports were suggesting there could be a bit of slip there. Sugar prices are on the rise. What's your take in terms of how volumes will likely turn out next year and what will happen to the pricing?
As far as Balrampur Chini is concerned, we are expecting a minimum of 10% increase in our cane crushing volume from the year gone by. And we started our crushing in 2 of the units yesterday. And for the units which are located in eastern part of the UP, we expect to start the crushing by after 15th of November. For your question on the realization is concerned, for the 6-month period, we achieved a realization of around 37 rupees 28 paisa per kg. And for the quarter ended, it was 37.66. Currently, we are selling sugar at around 40 rupees per kg. As the country is sitting on a very tight inventory, it is around 2.5 months of consumption only. We don't see a significant correction to happen from the current levels in spite of ongoing sugarcane crushing season.
And what about the overall debt situation? Still continues to be around that 550 crore mark. Any plans to pare it down?
So the reason why these debts are sitting on the balance sheet is most of it is enjoying a 50% interest subvention from the government of India. So out of 550 crores, almost 360 crores carries interest rate between 4.25% to 4.5%. That's the reason this loan will continue to remain on the balance sheet. And in the next 3 years, as per repayment schedule, all this loan will be repaid.
On board, thank you so much for giving us a lot more clarity as to how the business is shaping up and the outlook on ethanol prices as well. That's the view coming in from Balrampur Chini, but let's move from one corporate voice then to another. And Alembic Pharma in the spotlight. They have seen a pretty decent set of numbers. What's their plan for launching new injectables? Where do they see their trends for the domestic formulations business? Shaunak Amin is the managing director at Alembic Pharma and now joins in to answer those questions. Shaunak, thanks for taking time out. You had that EIR report in place for all of the facilities that are focused on the US generic market. Can we expect the US sales then in the second half to be better than what we saw in the first half? Or will it be a price or volume-led growth?
We don't usually give a forward guidance, but if I could, comment on the US market, it's largely we see a bottoming out in terms of price competition, and you could see sequentially we have seen some momentum on our growth numbers. I think from our planning point of view, we have approximately 10 new launches lined up in H2 of this financial year. And we hope some of those can give us some traction and build up some momentum on those sides. In terms of whether it will be a price or a volume, at the moment, we're seeing predominantly a volume-led growth at this point in time. But we're hopeful that we can get some one-time opportunities to supply the market, and which should give us which should hopefully, can give us some amount of price-led growth also.
So then the question is, will the second half see similar growth rate as the first half, or will it be better?
Yeah, I can say that we are quite comfortable to say that.
You're planning new launches as well in injectable segment. What we understand is that the growth has been better in the US geography. What's leading to injectables grow, and how long do you think this outperformance bout is going to continue?
Yeah, so usually we don't give a product-led split of the growth numbers, but all I can say is from a portfolio level, like I said, we have 10 new launches lined up in H2. I wouldn't comment on the mix of the launches at this point in time, but I think we're hopeful that, with our newer plants, both in derm as well as injectables, we hope to see some additional traction coming from these two product lines, in addition to our oral solid dosage formulations of the past.
You added new division in the animal healthcare business as well. How much incremental growth can you expect in the top line from this division? And are the margins here better than your consolidated margins?
So I think the margins, so firstly, I think on the veterinary side, we have added one more division with 350 people in it. And we've seen a significant growth momentum. And if you see this quarter's numbers, they are in fact representative of the additional manpower that has given us additional momentum. We expect this momentum to continue growing forward. And in terms of margins, I would say the veterinary margins are maybe just around our overall margins, maybe just a touch lower than what our overall margins are.
Sure, but talk to me about the US geography as a whole, because we have been getting this report about drug shortage, etc. How's it helping your company?
So at the moment, we haven't seen any impact of these shortages on our supplies at this point in time. But if it does come along, I think we're quite confident that we are in a position to capitalize if there is any one-off drugs or shortages in the products that we are supplying.
Okay, Shaunak, so not a big impact when we talk about the US business, but in DF, how did seasonality play its role? Was it at par with your expectations, and how are you seeing the full year pan out as far as the domestic formulation business is concerned?
So on the India business piece, if you look at Q2 last financial year, I think there was a combination of a post-COVID buildup of sales as well as some amount of post-COVID hangover in terms of the flu season, which we didn't see this year, partly due to an extended summer season. The growth for India business on the acute and the respiratory side was extremely subdued, not just for us, for the whole industry. But I feel this is a one-off, largely contributing to the past disturbances that COVID has caused us, which got exacerbated by an extended summer season. But I think going forward, we expect things to return back to normal, even for the acute as well as respiratory markets.
And your gross margins have expanded quite smartly by 110 basis points year on year to about 71% due to a superior product mix and lower raw material costs. Do you believe that this looks sustainable?
So on the margin side, I think as long as we see some top line growth, as long as we see in terms of product mix getting traction going forward, I think we usually don't comment on future earnings, but I think I could say we are at a comfortable point both for US as well as non-US as well as the India business in terms of maintaining this rate of growth.
Right. Great to then have you on the show. Thank you so much for taking the time out and speaking with us today. That's the highlight coming in from Alembic Pharma's numbers. But we'll take a very quick break. But let's hear out what are some of the Pataka stocks that Pankaj Murarka from Renaissance Investment Managers is betting on this Diwali and why he likes some of these names. Also hear it out from Vinit Bulinjkar too.
Positive on Paytm as a company because I think fintech is at the intersection of finance and technology. And my view, probably some of these fintech companies will emerge as the fastest growing companies within the financial sector for this decade. So clearly, I like that. And now the companies turned profitable and probably they're going to have very strong growth over the next, let's say, 2 to 3 years. And I think valuations still are very reasonable. So in the context of the near-term growth over the next couple of years and more importantly, the opportunities that lie for the company from a medium-term perspective, I think it becomes a very compelling bet for me.
It's 11 times, has the best ROC amongst all peers. And even after absorbing the Teva merger, they're sitting on plenty of cash, good growth runway. They'll do 15% CAGR growth for a long period of time. And margin expansion from 19 to the 20s. I couldn't ask for a better story. Next 18 months, I think the stock could be at about 150 plus, very conservatively, and headed higher from there.
All right, lots of interesting Diwali programming lined up on ET now, so stay tuned because we've got a plethora of interesting shows. For now, the market's holding out at around the 19,400 mark. It's yet again the mid and the small caps where all the action is. So let's re-invite our chartists to find out what their chart buster ideas are. Kunal Bothra are joining in. And Kunal, take us through your outlook then in terms of your chart buster stock idea.
So it's on Godrej Properties. We were discussing how the real estate index and the real estate stocks have performed in the last few days as well as over the last few weeks. And the charts for Godrej Properties are very intriguing because the stock is at a multi-month breakout. Now the pattern which the stock has formed is also very, very strong. This is what we classically call it as a bullish flag kind of a formation where the stock took resistance at the 1700 mark. So you can see multiple times the stock tried to come closer to the 1700 odd levels. We saw the stock taking resistance. The way in which the stock has entered into the rally, look at this as a multi-year correction or multi-month correction for Godrej Properties, where the stock corrected more than 50% from 2700 highs to almost at a point where the stock was on the verge of breaking below the 1000 levels. So after such a kind of a sharp fall, the first leg of rally has been quite strong. The stock went to 3 months of consolidation. Just about in the last couple of days, the stock has confirmed a breakout of this bullish flag formation above the 1700 mark, which I believe could now act as a major support for the stock price. So very bullish on the stock price, expecting this to get into a breakout. Ideally for flag formations, the base as well as the height, the difference between these two levels forms the target of the breakout. And if we expect the similar kind of a pattern to play out, then we could be looking at Godrej Properties to maybe come back closer to 2400, 2450 mark over the very near term.
Right. And Kunal, what stocks are you recommending to trade right now?
So 2 buy calls. The first one is Aban Poonawalla FinCorp, something which we discussed in the morning. Looks quite strong. Again, the stock has done pretty well for itself at the start of the day today. So would revise the targets higher to 400 and stop loss could be trailed higher to 345, maybe 350 levels, looking at the current price for Poonawalla. And the second would be Aban PNB, again bullish on the PSU banking stock, flagging a target of 82 on a very short-term basis, and stop loss remains at 70.
All right, thanks very much for running us through all of your top stock recommendations and chartbuster idea. Let's get a move on and shift focus then to the Adani Group. And as India and the US come together to curtail China's influence on the South Asian subcontinent, we understand that the US will be injecting $553 million to fund the setting up of a port terminal in Sri Lanka by Indian billionaire Gautam Adani. Don't forget to catch that mega exclusive only on ET Now, as we've got the Adani Ports chief, Karan Adani, to discuss the investment and the road ahead. On that note then, and that of course is in conversation with my colleague Ajay Sharma, which will be later on the show.